Hello and welcome to Moneylife News and Views. I'm Debashis Basu. This week we are going to discuss what's happening at the markets. Why are the stock markets so firm against major tariff war raging around the world? When the US President Donald Trump detonated a trade bomb on April 2nd, global markets shuddered. The levies, steep tariffs set to bite from April 9th, targeted countries with 10% baseline tariff and a punitive 145% on Chinese goods. Stocks tumbled for 4 days as investors braced for chaos. Yet, days later, President Trump paused the tariffs for 90 days, excluding China, and exempted electronics, triggering a relief rally. Interestingly, that relief rally has now morphed into a full-fledged bull market, especially in countries like Germany, which has now hit a lifetime high. Even though the US is supposedly facing the prospect of empty shelves in a few weeks, the S&P 500 has recorded 9 consecutive days of positive closing, its longest winning streak in 20 years. On Friday, it closed at 5686 above its pre-tariff level, which means it's recovered completely from the fall. The Indian market brushed off the drama and climbed 3.5% in April. The exuberance is perplexing. Tariffs, after all, are taxes by another name, inflating the cost of imports. Yale University's Budget Lab estimates that 2025 tariffs will hit US consumer prices by 2.3%, costing households $3,800 annually in 2024 dollars. Car prices could rise by $2,000 to $10,000, iPhones by 40%, and groceries will not be spared. The IMF, citing the tariffs, slashed its 2025 US growth forecast from 2.7% to 1.8% and pegged the global recession risk at 60%, up from 40%. US GDP growth may shrink by 0.9 percentage points in 2025, with businesses facing higher input costs, squeezed margins, and potential layoffs. Global supply chains, already fragile, risk further disruption, while retaliatory measures threaten American exporters. Farmers and manufacturers in rural heartlands stand to lose the most, as they did in 2019 trade war. The dire prospects are reflected in the Consumer Expectations Index, based on consumers' short-term outlook for income, business, and labor market conditions. This index dropped 12.5 points to 54.4, which is the lowest levels since October 2011 and well below the threshold of 80 that usually signals a possible recession. In short, there is no upside so far to Trump's tariff tantrums. As per all economic indicators and forecasts, only a downside. That is, higher consumer prices, slower growth, potential recession, disrupted supply chains, retaliatory trade barriers, market volatility, and strained alliances. And yet, investors have been remarkably high-spirited, as if whistling in the park on a sunny spring morning. What gives? I believe in paying attention to sustained market moves because that is an objective reality collectively shaped by the wisdom of the crowds. By contrast, narrative is subjective and based on cherry-picked data or incidents. So what is the message that the market is sending us? The obvious initial driver of market gains has been President Trump's 90-day pause on reciprocal tariffs for most countries, excluding China. This sparked a massive market rally, quite understandably, with the S&P soaring 9.5%, its third best day since 1940, and the Nasdaq jumping 12.2%. Since then, investors may be calling the president's bluff, and that is probably what explains the continued market rally. After all, historical precedent from the 2018-19 US-China trade war suggests that markets can recover quickly once tariff uncertainties are addressed. Investors now appear to be wagering that this trade war too will end in an 11th hour compromise. Curiously, this bet is being placed not by the usual suspects on Wall Street, but by retail investors. While institutions have sold off through April, retail investors have been buying the dip, unfazed by tariff headlines. If the market is right, this could mark a rare moment in which mom and pop investors outplayed the professionals. Economic data lends some credence to their optimism. April saw 177,000 new jobs and inflation cooled to 2.4% in March, below forecasts for 2.6%. In India, a weakening dollar against the rupee lured foreign investors back, while domestic funds, now outstripping their foreign counterparts in holdings, kept buying. A more cynical view may be legal, not economic. Trump's second term agenda is under siege in the courts. Over 200 lawsuits have been filed challenging a range of executive actions, with 70 federal rulings on issues from immigration to federal spending thwarting his plans. The Supreme Court has already blocked deportations under the Alien Enemies Act, and Mr. Trump's use of the 1977 International Emergency Economic Powers Act to impose tariffs may yet be struck down as illegal. After all, it's the Congress which has the powers to announce tariffs. If the courts agree, many of Trump's most disruptive policies may be rolled back or neutered, restoring a semblance of stability. If judicial challenges neuter his politics, it would mean a swing back to Biden's stock market, implying stability or growth without Trump's disruptive policies. In the end, the market may be messaging less about trade policy and more about Trump himself. If the president has his way, the current cheerful optimism may turn out to be reckless. But if, as it appears, investors believe the president would be constrained by courts, by Congress, or by his own volatility, then his threats may not matter. Tariffs, in that case, are noise. The signal in the market is elsewhere. Hope you liked it. Thanks for watching, and please do share and do subscribe to this channel. Thank you.